It's very, very easy to use and repetitive, and it's proven to work for all pairs, okay? Fast trades, good entries, and exits. In today's video, I'm going to give you a whole complete breakdown on how to use this simple scalping strategy to help you make money and most importantly, get profitable in the long run. So without any further ado, let's get straight into the charts and then I'll show you. So these are the steps to follow with this strategy, okay? The very first thing that you need to find is break of structures, okay? Next up, you need to trust your fair value gaps, all right? Wait for them to be filled and then finally wait for confirmations, okay? Now, do not mind, I'm going to show you all that, okay? Now, the very first thing that we need to identify is the fair value gaps, okay? Now, this is pretty much how it's formed. Now, remember, whenever we have, say, a push to the upside, the price is going to move, okay? Push to the upside, pull back and then push, and then what happens is more often enough the price leaves these gaps, okay, and we call that fair value gaps. All right, so this means at some point these gaps have to be filled, and that's pretty much where we take our trades, okay? Same thing if say we had a downtrend and say the price is pushing down just like this, all right? So we have a push and then a pullback, and then we have a gap in here. You see that? So again, this would be our FVG, okay? So these are the areas where we want to find our trades, all right? As I mentioned, this is repetitive because it happens over and over again, all right? Now, one other thing that I want you guys to understand is since it's a scalping strategy, we are basically using smaller time frames. So in this scenario, our bigger time frame is going to be the M30, all right? So we start off from the M30 and then scale down to the M5 for our entries. Rather than going to the H4 just like how we often do for our normal strategies, this time around you are starting from the M30, find how the price is behaving and scale down to the M5 for entries and you're good, all right? So this is a good example so you can clearly see. So we have a push to the upside and then we have a fair value gap drawn out here, and then what we need to wait for is for the price to come back to tap into that gap, and then we would be able to take our trades from here, all right? Now there's an example on the British pound. This is it, and as you can clearly see, we have a clear push to the downside, all right? And now we have a fair value gap here, all right? Then we have one more here. Now what we need to see is we need to see the price tap into that zone and then drop down, or tap into this other zone here and then drop down. So all along, all you just need to wait for is for the level to be tapped into, all right, and then you'd be able to take that trade, and that's how easy it is. Or maybe let me show you pretty much a better example on how the fair value gaps are formed, okay? Firstly, you should see at least a series of 3 consecutive candlesticks, okay? So I'll give an example. Say it's an uptrend, you need to see a series of 3 bullish candlesticks, okay? So we have that, and then we have this over here, okay? We have a wick, we have a wick, we have a wick, and then we have a wick, we have a wick here, and then we have a wick. So a valid fair value gap should be something like this. We should see some space between the wick of the first candlestick and the wick of the third candlestick. So we have this, and that would be valid. But then on the other side, if say this wick dropped down up to this point and say this was somewhere here, well, this would be invalid because there is pretty much no gap in between, and that would make it invalid. So you should have at least a gap between the wick of the very first candlestick and the wick of the third candlestick to ensure that that's valid. Let me show you on the other side in a downtrend. So again, pretty much just like this, we have a series of 3 candlesticks to the downside, okay? And then we have this. Cool, so we have a wick, we have a wick, we have a wick, have that, and then this, and then this. Remember, again, as I mentioned, it should be a series of identical candlesticks. So in this scenario, they should all be bearish, okay? Not having a bullish and then a bearish, no, they should all be identical, okay? So again, in this scenario, we'd have our gap stretching from this area to this area, okay? Again, that makes it valid. Well, that means in summer, we just need to wait for the price to tap into the zone and then drop, and then we have our entry, okay? Cool, now let's proceed and then check that out, okay? So we've had our gap here and then we have this, and all we just need to wait for is for the price to tap into that zone and then find our entry, okay? Now, this is all done on the M30, okay? finding your breakout structures, finding your fair value gaps, and then waiting for the price to close in, and then scale down to smaller time frames, pretty much M15 or the M5 to now get the entries. Okay, now for the fact that you're watching till this point, I welcome you to join the exclusive family by smashing the subscribe button. The target is 1 million subs and you could be part of this exclusive community. So just go ahead and smash that subscribe button, and without any further ado, let's get straight back into the video. Let's go. So this is what validates a fair value gap. Okay, so number one is we should have no mitigation, so the level shouldn't be tapped into, okay, because that's why you want to take your trade, and the price should close within the fair value gap. Okay, so it should close within, and I'll show you that in a minute. Okay, then bigger gaps are better signals, and I'll show you that, and then M5 for entries. Okay, so if the gap is big, let me give an example. Say we had a pretty much bigger gap like this. This makes it more valid than if we had a smaller gap just like this. So this shows that, okay, there is more possibility of this gap having to be filled for us to pretty much proceed and get our trade. So let's go to the charts and trace real examples. So this is on gold, and we need to quickly go ahead and see how it looks. So we have the trend to the downside, and that's very, very important if you're going to be scalping. Pretty much follow the trend, okay? That's it. Remember, when you're scalping, you're taking short-term trades, so you want to really go with what the price is telling you. Well, on the other side, it's also possible that you could just, go against the trend, or maybe that would also be a different video where I get to share that with you. But in here, I would always suggest that follow the trend. Now, how do you identify that? Remember, we said you can only identify that if the price is breaking all the previous highs and lows depending to form newer structures. Okay, so let me give an example in here. So we can clearly see that the price is pushing to the downside. Why? Look, the price breaks a low to push down, breaks our lows, push down, break our lows, push down, and then it breaks lows to push down. So you have these areas as your breakout structures, okay, with a price breaking all your previous lows. Can also have this here. So it's a downtrend, but the price is continuously breaking all the structures. That means it's continuous, okay? And in other words, we'd need to look out for sales, okay? Furthermore, let's go ahead and now identify these fair value gaps, okay? So just go over here and let's see. So we have a bearish candlestick, we have a bearish candlestick, and then we have another one. So yep, we have this as a fair value gap, and it's valid. So we have this over here and then this, and that's how I got to draw this level here. Then next up we have other ones. We have this and then this. Okay, this is also a gap, you see, because we have a bearish candlestick, then we have a bearish, and then another bearish, only that it's very, very small. And remember, we said the bigger the gap, then the better. All right, now we have another over here. So we have this bearish candlestick, and then we have this bearish candlestick over here, and we have this gap here. So in other words, we just want to see the price tap into that zone, okay, and then we are able to sell. Now at this point, that's when you need to start scaling down, and we shall go over to the M15 and then see. Okay, now you don't want to instantly take that trade because we have a gap and you've seen the price tap into the zone, because sometimes the price is definitely going to break out and then push to that other gap and finally drop down, or it may not even respect any of your gaps. Okay, so that's the thing about trading. Not everything is going to happen the way you really want it, but all you need to do is wait for the price to react, and then you're able to take those good trades. Okay, so let's proceed and check how this actually looks. So we have now the price into the fair value gap. Okay, you could actually go over the M5 and then see. So now we have the price into the gap. Again, as I mentioned, we don't want to have our trade here. No, that's not a good idea. You could have your stop loss just slightly above the fair value gap, but remember, as I mentioned, nothing is guaranteed. So again, the price could just break out and push up. So what you need to wait for is for the price to break the previous level, okay, or in this scenario the previous high, and get to confirm that entry. So in here, we first need to wait for the price to finally break out here, and then we'd be able to take that trade. Okay, so it's pretty much easy. You could just have to go ahead and set draw level here, all right, and then have your order right here. Now you could have this as a pending order or an instant execution where you get to watch the charts closely and then see what the price does. So we need to first wait for the price to show that there's now a momentum push to the downside and then confirm that. So let's just go ahead and play that and see. Okay, there you go. Cool. So we now have that. So we've seen the price push down, and now that will be a valid entry right over here. Now for us stop losses, it's pretty much tricky, but the best option to place your stop loss should be just out of the fair value gap, but that's pretty huge. But now once you have your confirmation, it's still easy. You could now have your stop loss just within the zone, all right, or the gap, and then have your take profit. Could even be down, obviously looking at the price, feeling that gap, because in other words it's still proceeding down, and then play that. Let's have a look. Okay, there you go. You see that drop. Okay, there you go. So pretty much good, and that's how easy it is. So this is a very, very easy strategy, and the coolest thing is this is repetitive, and that means we can even try it over and over again. I'll give an example in here. All right, within this exact trade we have another gap. Let me show you. So we would have this gap here. All right, there you go, and now this wasn't filled, but then we have another gap. If you stretch this down, and there you go. Okay, again you can clearly see the price drops down, comes into the gap to fill that, and then a huge drop to the downside. So it's really easy, and the most important part is you can always use it over and over again. Now for the fact that you're still watching till this point, I really do understand how much you really care about your trading. And look, I created a free course that shows you the 3 stages of becoming profitable as a trader, and it's entirely free. Just go ahead and click the link down, fill in the form, and then I'll send you that exclusive video so you get to understand what it really takes to move from the first stage to finally becoming a profitable trader. And as always, keep it less talk and more action. And if you aren't subscribed, well, I don't know what you're waiting for, but smash that subscribe button, and I'll see you in the next one. Let's go. Cheers.